Great. Hi, friends. This is Rajneesh. I take care of products for investments and capital markets for Kotak Mahindra Bank. And along with us today, we have Mr. Ashish Somaiya, who's the MD for White Capital AMC. Uh, Welcome, Ashish. Uh, Friends, I've been knowing him for the past 15 years, and he was earlier heading Motilal Oswal AMC. And I remember well when he exited Motilal Oswal AMC from almost 1,300 crores of AUM, which he got in 2013. Uh, he made it grow to almost 40,000 crores of AUM in 2020 in 7 years' time. So, really, very well rewarded in the market. Welcome, Ashish. Are you there?
Yes, hi,
Hi.
Rajneesh.
Hi.
Thanks for having me.
Friends, the topic for today's discussion is why do winners rotate? And this information actually comes over uh, with a lot of experience out here. I mean, if you really talk about on one side the returns which have come in the last 6 months' time, you will see that large cap funds have given a return of 11%, mid caps have given a return of 31%. If you talk about small caps, they've actually, in fact, given the maximum return of almost 40%. So, on one side, the returns have come as far as market capitalization is concerned. On the other side, if you also look at sectors, similarly, we'll see that financial services, which everyone reveres, people say ICICI Bank will do really well, the numbers are coming really nice. State Bank of India, the numbers are really coming nice. But for the last 6 months' time, the returns have only been of 5%. Compare it to a sector like a reality, and you will see that the returns have been to the extent of 40%. So my first question to you, Ashish, is that can you just throw some light on it? I mean, does it have something to do with not only results but also the market cycle or the market psychology or investor sentiment or any other factor apart from it, Ashish?
Yes, Rajneesh. So, Rajneesh, actually, what you highlighted, in terms of sectors and winners which keep rotating and keep changing. In fact, from an investor's perspective, I know that, there are many mutual fund investors that you represent and you advise, or who you do product selection for. And of course, Kotak Cherry also does. And then there are many investors, there are millions and millions of investors who invest in mutual funds. Now, what you described about rotation in the markets, the direct impact on investors is that the best performing fund, the best performing fund manager, and the best performing fund house also seems to be rotating as violently. In fact, I have observed in my entire career, say 24 years now, I've observed in my entire career that the best performing fund house, the best performing fund manager, and the best performing scheme practically changes every 18 to 24 months. And I did one, my team along, all of us, we did some research where we did a very, very simple thought experiment and then we tabulated some data. So just imagine that, let us say we are now on, say we are on 18th October, but for ease of example, I'll just say 30th September. So let's say we are on 30th September 2023, okay, and we have to decide to invest in certain mutual fund schemes. Now, one of the things people do is to look at last 1 year return or last 3 year returns because they've been told that you should, while past performance is not an indicator, etc., kind of disclaimers are put. But the reality is that people generally look at past performance. And, if you take a lot of, if you take internet websites, if you take social media, if you take a lot of digital interfaces, they do stack up performance, in descending order of last 1 year or last 3 years or some such data. Now, the experiment which I was describing to you, so let's say we are on 30th September 2023, and I have to pick, for me to invest, I have to pick some equity mutual fund schemes. So on 30th September, if you go back and see that, okay, 3 year performance, let's tabulate all the equity mutual funds based on their 3 year performance. So obviously, if you take last 3 years, you will get some funds with rank number 1, 2, 3, 4, 5, 6. There'll be hundreds of funds, and we actually removed sectoral funds and thematic funds and index funds and ETFs and stuff. We only kept diversified equity funds. Okay, so on 30th September, if you were to tabulate based on 3 year performance, then obviously you will get a bunch of diversified equity funds, and you will be able to rank order them based on their 3 year performance. Now, on 30th September, if I have to make an investment for the next 3 years, so let's say we So what I do is I pick the top 5 or top 10 funds and put all my money in the top 5 or top 10 for the next 3 years. So on 1st October 2023, I started a 3-year investment. And where did I make that 3-year investment? I took as of 30th September 2023, which were the best performing funds in the previous 3 years. Now, if we all regroup on 30th September 2026 to check that you bought 2020 से लेके 2023 in those 3 years, the best performers, you invested in all of them, and now you have regrouped on 30th September 2026 to check how did it fare. You know what is our finding? Our finding is that there is absolutely no correlation between what is the rank of a fund in the period of observation of those 3 years and what will the rank of the fund be if you invest in it for the next 3 years. There's absolutely zero correlation. Look, it would be very useful if there was 1:1 correlation. It would be very useful because then you would be able to say that past 3 years performance is a good indicator of next 3 years performance. That is obviously not there. If it was inverse correlation, saying -1, that okay, past 3-year performance means that next 3 years it will do badly, which means that past 3 years, whatever did badly is likely to do very well in the next 3 years. So let's buy that. But there is no +1 or -1 correlation. What the data shows is that the ranking of performance in previous 3 years has absolutely no correlation with where it will land up in the next 3 years. Now you might say, why did you take 3 years? We've done that homework even with 1 year performance. Basically, if you take funds which are, and you don't go by rank, there are hundreds of funds. So rank to kitna karoge aap? But you just divide the funds into quartile 1, quartile 2, quartile 3, quartile 4. So if you say that last 1 year, whichever fund is top quartile, I will invest in that. So probability, if a fund is top quartile in last 1 year, if you see that and you invest in that, what is the probability it will be top quartile in next 1 year also? That probability is less than 30%. So basically what we have seen is that, just like you described in your opening comments, just like you described, that sectors rotate and what was doing well 6 months back and what was doing well, it changes. The fact is that all of that basically for retail investors, it results in this phenomena, which is the title of our talk today, that winners rotate. Now, we will, as we go along, we'll discuss why it happens. But clearly, the big thing is that, regulator tells us to put disclaimers like past performance is not an indicator of the future. I think it's about time that investors take it very, very seriously, because I've shared data with you, which actually proves that past performance has nothing to do with future performance. In fact, there is no correlation.
So Ashish, then
Like
how do you then catch the winners regularly? I mean, that's what my second question to you. I mean, ultimately, yeah.
Yeah. So, I think, Rajneesh, what is the key point that, so let me just elaborate that why does this really happen? See, what happens is that the market is huge. It has like 7,000 plus listed companies. But we are not talking about 7,000 companies. If you look at the broadest manifestation of market, like I'm first answering why do winners rotate?
Yeah.
And then I'll come to, your question that, how do you identify who will do well and, then what is this whole exercise about? It's not all a lost cause. But first, let's do the diagnosis that why do winners actually rotate? See, the point is that, like I said, there are thousands of listed companies. We're not discussing thousands of companies. But if I take just the equity market, the broadest representation or broadest manifestation of the equity market is, say, BSE 500 index, right? Because those 500 BSE 500 index covers, I think, 93-94% of the entire market. So BSE 500 is a good representation of the entire market. So anybody who says that, I want to beat the benchmark is basically talking about BSE 500, because uske andar large cap lena, mid cap lena, small cap lena, wo sab to baat ki baat hai. Nobody starts off their journey by saying, I will buy large cap. Correct? Basically, what people are saying is that I want to invest in equities. And if you invest with active manager, then you should beat the benchmark. So anybody should keep in mind that benchmark is BSE 500. So what are we competing against? We are competing against BSE 500. वो बात तो clear है. Now, whenever you look at any fund manager, right, any active manager, to beat BSE 500, they will obviously have to do something different from the benchmark, right? Because To generate alpha, you need to have active management. And active management is manifested by having active share in the portfolio. Active share meaning how much does your portfolio deviate from the benchmark? Because obviously, if the benchmark is BSE 500 and it has all these stocks and sectors and market caps and stuff, then obviously if you want to do better than the benchmark, you'll have to do something different from the benchmark. Like there is a popular cliche that if you want to beat the benchmark, you cannot buy the benchmark, right? So if you want to beat the benchmark, your portfolio will deviate or do something differently from the benchmark. Now, most fund managers, how they create this active share, or how do they create this differentiation or deviation from the benchmark? So you must have popularly observed that whenever you read literature, or whenever you read any big fund manager's website, or you read their presentations, or even when you hear them speak, they spell out for you what are their preferences and how they invest. Like say for example, somebody says that I am a specialist in small cap. I think paisa to small cap mein banta hai, right? Some people are specialist of small cap. Some people are specialist of even micro cap. Some believe that chore company bhi more ban jayega, right? There are some people who are growth investors. Some are even a further subset of growth investors. They will only buy secular companies or defensive companies. And there are some who will say we are value investors, and within value there could be even subsets, because they could say they could claim to be contrarian investor or a cyclical investor or something like that. And there are some people who prefer to invest in private sector companies, and some people who say that at a price anything is good. So what if it is public sector chodo state government mein chalega? Correct. So basic point is that everybody comes to the market with their own thought process, their own recipe, and their own beliefs. And all of these thought processes, recipes, and beliefs, when you look at it vis-a-vis the benchmark, they actually infuse biases in the portfolio, because the benchmark has no bias. That is why it is the benchmark. The benchmark is all encompassing. The benchmark is the market. And the market by definition, or benchmark by definition, has no bias. But the people who are entering the market to beat the benchmark, they are coming with certain preferences, they are coming with certain biases, or they are coming with certain recipes. Because some people believe that growth will work, value will not work. Then there are people who equally vehemently believe that value will work, growth will not work. But boss, BSE 500 का beta 1 है. By definition, BSE 500 is half growth and half value. So, and at different points in time, different sectors, different market caps, and different segments of the market will do well. Let me give you more practical examples. If you see 2016, 17, and 18, what worked in the market? What worked in the market was domestic cyclicals, growth oriented companies, auto ancillary, oil marketing companies, mortgage companies, private sector banks, smaller ones, mid cap banks. All these things worked very well in 2016, 17, 18. In 2018, till 2018, this worked. In this period, IT and pharma were hated sectors. But in 2019 and 20, only IT and pharma worked. And if you thought that 2019-20, if you got convinced that IT and pharma are the best sectors, then in 21-22, they just didn't work. And in 21-22, mainly oil, metal, commodity, PSU, these kind of things worked. Now, what changed? Why should this happen? Because till 2018, anybody who was a believer of growth was actually number one. In 2019-20, anybody who said that you should buy defensive companies, high quality companies, that is what worked. And in 2022, anybody who said you should be contrarian or value, that is what worked. The best performer of 2016, 17, 18 did badly in 1920. The best performer of 1920 did badly in 21-22. And the best performer of 21-22 was nowhere in the reckoning for the previous 5 years, right? So in all of this, what has changed? It's not that the fund or fund manager or fund house has changed. It's not that suddenly these highly intelligent people suddenly lose all their skill sets and competencies. So what has changed? What changes actually? Basically, what changes is the macroeconomic parameters. In 2016, 17, 18, when domestic companies and domestic cyclicals did well, the environment was such that interest rates were low, liquidity was high, the rupee was consistently 63, 64, oil was behaving itself very, very well. In the end of 2018, oil went to $88, ILFS defaulted, there was a credit crisis, rupee went to 72. Suddenly, IT and pharma, which were hated sectors, they actually became tailwinded sectors because rupee started depreciating and domestic economy went for a tailspin. And then after COVID came obviously digitization and all. COVID is a macro event. Oil prices going to $88 is a macro event. A big institution defaulting and causing a credit crisis, it's a macro event. A war in the Middle East, a war in Europe, which sends oil prices to 125, which creates demand for coal and which throws ESG out of the window, that is also a macro event. So, what is the learning? The learning is that everybody seems to be approaching the market with a certain preference, which infuses bias in their portfolio. But they are competing with the benchmark, and the benchmark has no biases. बंद घड़ी भी दिन में दो बार सही वक्त दिखाती है. That is how the benchmark behaves. There is no part of the benchmark which you can convincingly say that this will just not work. So the point is like this, that to beat the benchmark, people have to create active share in the portfolio. If you create active share in your portfolio by saying that I like this, I don't like this. I narrow down my universe because I'm a growth guy, or I narrow my universe because I'm a value guy, or I operate on a narrow universe because I'm a small cap specialist, or I operate on a narrow universe because I like only defensive sectors and I don't like cyclicals. So, in any form or format, if you narrow down your investment universe based on slicing and dicing the market on these top down parameters, that means you are going to operate on a much narrower universe. When the universe in which you operate, if macros cause that part of the market to be tailwinded, you will be a hero. When macros change and it causes your segment to be headwinded, you will become a zero. But somebody else, your headwind will become somebody else's strategy's tailwind. And somebody else's tailwind is your headwind actually. This is why this is why every year or 2 years or every 3 years the best performer changes. It's not that they've lost their skill or their tactfulness. It's just that a lot of the performance comes by being in the right place at the right time and enjoying a tailwind. And a lot of the performance gets pulled back when macros change and convert tailwind into headwind. Now, as opposed to this, there is this concept, you hear about factor investing a lot nowadays. Everything that I narrated to you, macros cause certain factors to do well and cause certain factors to get hit back,
Yeah.
right? So whenever people have pronounced preferences or biases in their portfolio, see when you see that a fund has done very very well in the last year or 2 years, you should ask what are the biases or preferences of this manager. Is it that he did well purely because he has mind blowing stock picking, or is it that he did well just because the segment in which he was operating has become massively tailwinded? In 2022, everybody who had PSUs was a rock star. But in 2015, 16, 17, 18, 19, they were all down in the dumps. And everybody who owned PSUs did not predict the war, right? So that return came because of right place, right time. How long will it sustain? That is the question. So I think that the, the way to look at fund performance, I think that is where the trick lies. If people are generating performance because of tailwinds caused by macros, I can tell you it's not going to be sustainable. If people are able to generate performance by neutralizing all the macros, but generating performance purely based on stock picking, then I think that is something which is going to be sustainable. I think sophisticated investors do all this attribution analysis, etc. That is where the real answers seem to lie. Sorry, I gave you a long-winded monologue, but I'll pause
No,
there.
no, perfectly fine.
I'm
So
sure you have
perfectly
questions.
fine. So I mean, there are two choices which any investor has. The first choice is you purchase those five stocks at any given point of time. One or the other stock will perform if they are in five different sectors. So that is what a normal retail investor might want to do. And the second option primarily is that to buy those active shares primarily, which are being neutralized by the tailwinds which you're talking about. Now, tell me how much
Yeah.
practical it is to stay away from the market scene, Ashish. I mean, there's a lot of discussion which happens on in White Oak. I hear a lot about the active share. Is it really possible to give delta returns through active shares?
See, having for any active manager, having active share vis-a-vis the benchmark is a must. So let's say since you took our example, if you take, let's say for example, if you take a flexi-cap fund which we manage, we launched about a year back, a year and a quarter back, it's done very well. If you take that flexi-cap fund, the benchmark is BSE 500. Okay. our portfolio is 60% active compared to BSE 500. So just for sense of reference, what it means is that BSE 500 has a certain allocation to stocks and sectors. If you were to compare our portfolio, it is 60% distinct from BSE 500. And just for reference, anything which is 60% is clearly actively managed. Anything which is less than 50%, is like, quasi close to, like 30-40% active is like, quasi indexing. Your portfolio is too close to index, right? Then people might just as well buy the index. But 60% active is a pretty high number for a flexi cap fund. So we are active managers. There's no doubt about it. And since our inception, we have generated alpha. Now the question is this: that how did we create 60% active? Did we create 60% active by saying that I'm a growth investor, I will not buy value stocks? तो obviously अगर आप आधे मार्केट में इन्वेस्ट करेंगे, आधे मार्केट में नहीं इन्वेस्ट करेंगे, तो आपके पोर्टफोलियो में एक्टिव शेयर आ ही जाएगा. Because at ab initio you have differentiated yourself from the benchmark. The benchmark is growth as well as value. You are saying I am only going to go for growth, which means you have selected, segmented half the market, and you have said half the other half doesn't work. If you say that I prefer domestic companies, I don't like global macro, US economy वगैरह नहीं समझ में आता, I will only buy domestic companies. There are, by the way, some fund managers who don't buy IT. They don't buy commodities, they don't buy IT, they only buy domestic companies. भाई इंडेक्स जो है BSE 500 जो है, that is approximately 60% domestic and 40% export oriented. तो अगर आप बोलेंगे आई बाय ओनली डोमेस्टिक कंपनीज, तो ऐसा एग्जाम है जिसमें आपने 6 चैप्टर सिलेबस के पढ़ लिए, बाकी 4 चैप्टर आपने बोला सिलेबस के तो मैं पढ़ के नहीं जाऊंगा क्योंकि ये मैं नहीं करता, राइट? So how do you create, like we have 60% active share, but how do you create the active share? If you create the active share by saying that I do this, I don't do this, I do this, I don't do this, that means that you have created the active share by obviating participation in large parts of the market and by choosing to be in certain narrower parts of the market. इससे क्या होगा? जब डोमेस्टिक कंपनीज चलेंगी तो बढ़िया चलेंगी, अगर एक्सपोर्ट कंपनीज चलेंगी तो आप आउट, right? So when your chosen segment is tailwinded, you will do very well. But when your chosen segment doesn't work, you'll be thrown out of the market. Market will become out of syllabus for you. On the other hand, when we have a 60% active share, how are we creating active share? If benchmark is 60% domestic and 40% export oriented, we will also make sure our portfolio is somewhere in the ballpark. If benchmark is half growth, half value, we'll make sure our portfolio is somewhere in the ballpark. If benchmark is 35% defensive and 65% cyclical stocks, we'll make sure our portfolio is somewhere in the ballpark. If benchmark is 8% PSU, 92% private, again, we'll make sure our portfolio is somewhere in the ballpark. So what are we doing? All the tilts which are caused in the market because of macro events, all of those we are neutralizing. Then how is our portfolio 60% different from benchmark? At a stock specific level, we are 60% different from benchmark. But when it comes to the big factors which affect the market, when it comes to big macros which affect the market, there we kind of balance the portfolio. We cannot have perfect balance because then we will become the benchmark. But we try to make sure that all these biases, there we should be as close to balance as possible. But at a stock specific level, we should be as distinct as we can. So in technical language, you will say that all the systematic risk you are diversifying away. You are choosing to keep only the non-systematic risk which arises out of stock specific exposure.
Right. So there's a famous saying which George Soros had, that it's not whether you're right or wrong, but how much money you make when you are right and how much less of money you are losing when you are wrong.
Absolutely
right. So I understand from that perspective.
Absolutely right.
Great.
Absolutely.
So I just, maybe my last question on this, Ashish. See, there are these 4 stages in the market cycle, and you have the bull market, and currently we are going through a bull market. Many people predict that you have a market top. You also have the market bottom, and you also have the bear market. Are you primarily saying that even for a market bottom, this is the right strategy to follow?
See, look, when you are at the market bottom, let's take an example. When you are at a market bottom, in a falling market, you expect that. See, when the market is falling, okay, when the market is falling, portfolios which have lower beta, they will fall less, correct? And they will look like star. When the market is falling, somebody has a high quality defensive portfolio. Index ka beta 1 hota hai, market ka beta 1 hota hai, right? So anybody who has a high quality defensive portfolio full of pharma and FMCG and IT, their beta would be zero point 0.8 or 0.85. In a falling market, they would fall much lesser. Correct. It can also happen that in a rising market, the guy who fell a lot, they might actually bounce back. And in a rising market, the guys with high beta might bounce back more, and the guys with low beta, they might actually underperform. But the point is, market हमको बोल के नीचे नहीं जाता और market हमको बोल के ऊपर भी नहीं जाता है. So you should not be trying to generate alpha by trying to bet which way the market will go. Your alpha should come from stock picking. So the key point is like this, that irrespective of market bottom or market peak, see, investor के लिए risk क्या है? Investor के लिए risk है equity as an asset class. So investors think about how much equity, how much debt. But when you come to an equity manager, if you give money to me, we are an equity manager. For us, the risk is not risk of equity. For us, the risk is that after having entered equity, we should not be underperforming. Correct? So we have to generate outperformance through stock picking. We cannot be generating outperformance by trying to predict war कब खत्म होगा, अमेरिका का इंटरेस्ट रेट कब गिरेगा, अगर अमेरिका का इंटरेस्ट रेट गिरेगा तो डोमेस्टिक स्टॉक्स अच्छा करेंगे. तो वी कैनॉट बी फोरकास्टिंग ऑल दैट, क्योंकि वो कुछ भी चीज फोरकास्टेबल नहीं है, वो कोई भी चीज हमको बोल के नहीं होता है. Right? So portfolio should be such that under all macro circumstances, you are capable to outperform. If your portfolio is such that in certain macro circumstances you are tailwinded and certain macro circumstances you are headwinded, then obviously your portfolio is, it's not so much the stock picking which is working. It is just being in the right place at the right time which seems to be actually working. Let me put it differently. Nowadays, Rajnish, everybody's watching cricket. Let me put it in a very different manner. I think that might be interesting. Look, let us say, Rajnish, how do you see, when we see this T20 or one day international limited overs cricket, how do we see teams being built? You'll agree with me that typically a limited overs match, typically a good team will have 6 batsmen, it will have a couple of all-rounders, and it will have at least 3 specialist bowlers. And generally, you will find that the wicketkeeper is also a good batsman. That's how limited overs teams are built, right? Usually, that's how it is
Right.
built. Now, let us say that, Rajnish, we have to build a cricket team, and I tell you that, Rajnish, मुझे क्या लगता है, कल है ना हम लोग टॉस जीत जाएंगे. तो मेरा क्या प्रपोजल है कि जैसे हम टॉस जीतेंगे ना, तो हम तो बैटिंग ले लेंगे. और मुझे पता है कि ये बैटिंग पिच है. It's going to be a pitch which will enable high scoring pitch है, right? टर्न नहीं होगा. It's good for batting, correct? तो हम लोग पक्का कल टॉस जीतेंगे. टॉस जीत के हम बैटिंग लेंगे, अच्छी पिच होगी, और हम पहले बैटिंग लेते से ही विल हिट 350. So let's do one thing. Let's go with 8 batsmen and 3 all-rounders. Okay, let's go with that. Let's not make a team which is usually made. This time we will go with 8 batsmen and 3 all-rounders. So you say, okay, let's do it. कल हम ग्राउंड पे पहुंचे, टॉस जीतने के बदले आप टॉस हार गए, ठीक है? और आप क्या 300 मारोगे? टॉस हार गए आप, तो सामने वाले ने बैटिंग लिया, सामने वाले ने आपको 350 मारोगे. अब क्या होगा मैच का, आप बताओ. सो क्या होता है, क्रिकेट टीम है ना, कभी भी इट्स नेवर बिल्ट बाय अज्यूमिंग कि हम टॉस जीतेंगे और बैटिंग पिच मिलेगा और हम 300 रन मार लेंगे. ऐसे अज्यूम करके कोई क्रिकेट टीम नहीं बनाता है ना. तो पोर्टफोलियो भी ऐसे अजम्पशन करके नहीं बना सकते ना आप पोर्टफोलियो. लाइक यू कैन नॉट मेक अ पोर्टफोलियो फुल्ली डोमेस्टिक सिक्लिकल अज्यूमिंग दैट द रूपी विल अप्रिशिएट. एंड यू कैन नॉट मेक अ पोर्टफोलियो फुल ऑफ फार्मा सेइंग दैट कोविड का 5वां वेव भी आएगा, 6ठा वेव भी आएगा. And you cannot make a portfolio full of, you cannot make a portfolio full of commodity companies thinking that दो क्या तीसरा war भी आ जाएगा. You cannot tilt your portfolio with 15% exposure to oil thinking that oil price will again go to 125, क्योंकि आपको बोल के नहीं होगा. So the point is that things which are not forecastable, you have to balance for that.
Correct.
Things which are not forecastable, उसके ऊपर bet करके आप ना ही क्रिकेट टीम बना सकते हैं, ना ही आप अपना पोर्टफोलियो बना सकते हैं. जो चीज आप फोरकास्ट नहीं कर सकते उसको आप केवल हेज या बैलेंस कर सकते हैं.
Correct.
उसके बलबूते पे आप पोर्टफोलियो नहीं बना सकते. सो दैट इज द की थिंग टू कीप इन माइंड.
Interesting. Thanks, Ashish. Thanks a lot. Maybe now I think I'll delve out a little, divert a little, because I know that you understand international investing a lot as well. I just had maybe one final question before we open it up for the investors as well. Clearly, India is doing extremely well, and that is visible from our perspective. There's a number which we use. There's a ratio which we tend to use is a market cap by GDP. So if we really look at market cap by GDP, India is almost 110, one of the highest which was ever there. US might be at 170. But there's a country called China which is at a number of 52 or a 53, which is almost half of that of India. The earning growth which you're talking about, India in times to come, the next financial year is almost a 15% for EPS, and for China it is a 11% by consensus estimates. Do you really foresee, from a contrarian perspective, it is the right time for us to also start investing into the Chinese market?
See, I think, yeah, I mean, contrarian perspective, if you really ask me on a lighter note, I can say जिस किसी भी चीज के ऊपर बच्चा बच्चा convince हो जाता है ना, when everybody is certain about something, then definitely you should really think about it. Like 2 साल पहले ITC के memes बन रहे थे, right? फिर अभी थोड़े समय पहले लॉस मेकिंग कंपनीज और कंज्यूमर टेक फिनटेक के ऊपर मीम्स बन रहे थे. आजकल मुझे ऐसा लग रहा है कि लोगों ने डिसाइड कर लिया है कि एक जो सबसे बड़ा बैंक है, आपका नहीं, दूसरा वाला, उसका लोगों ने डिसाइड कर लिया है कि वो तो चलेगा ही नहीं. तो whenever people are, or like everybody is saying that China is going the Japan way. So when everybody is fully convinced, then definitely you are right. When everybody is fully convinced, you must think of, thinking that, okay, it can't be so sure. Whenever human beings are very, very sure about something, that is where things start to go wrong.
Yeah, I think
So you're
absolutely.
right in pointing it
Yeah,
out.
absolutely. I remember till close to around one year back, everyone was talking about ITC. Now everyone is talking about HDFC Bank, and I clearly remember ITC is double to what the numbers it used to be almost a year back. Absolutely correct. Ankit, do we open it up for questions for anyone here on the call?
So mostly if there are questions, people post it up. So if anybody has a question, can post a request as a speaker, and then we can have it.
Friends, if you have any questions, if you can just post it, I will ask the question from Ashish.
Actually, spaces are a bit tricky that way. So if anybody has a question, please request as a speaker, and you can speak up as well. Yeah, apparently, I guess there is some issue, but yeah, in case if there are questions that we receive later on, we'll address them separately. Then I guess.
So great, Ankit. So let's maybe conclude the call.
Yeah.
Ashish, it was a pretty interesting session. Thank you so much for being on the call. Maybe we'll see you later.
Thank you, Rajneesh. Thank you. All the best.
Thank you, Ashish, sir.
Thank you.
Thank
Bye.
you so much.
Thanks, everyone.